Hi guys, in this webinar series, we will look into technical analysis to trade even better. Technical analysis is a method of evaluating financial markets by analyzing statistical trends and patterns in price and volume data. It is used to forecast future price movements and identify trading opportunities based on historical market behavior. It is also based on the idea that relevant information about a market is reflected in the price movements and volume. So let's start with the principles of technical analysis. So it's basically the study of historical price data, including price, volume, and is used to predict the future price of securities by looking at charts, trends, and price movements. Prices move in different directions, history repeats itself, and market movement decides everything. So we have different chart types, and the most popular one is obviously the bar chart. We will take a look into that later. Anyways, it is a representation of the relationship between time and price and is considered the main component of technical analysis through which the price movement and market direction are analyzed during different periods of time. We have the hourly chart, daily frame, weekly frame, monthly frame, and even minute frame. So the important part is that we need to identify chart patterns because it's an important aspect of technical analysis as it can provide us with valuable insights into the market and potential trading opportunities. They're basically a visual representation of historical price movements that can help us anticipate future price movements, so it's easier for us to speculate. Now, opening price is the price for the first trade of the period of the first trade of the day, while the highest price is the highest price that the stock or the currency traded during this period, and the lowest is the lowest price that the stock or the currency or the product that you are trading on the day. Now, candlestick chart. Historically, they were used in Japan 600 years ago, and it has become very popular over the last 50 years. Each line reads 4 kinds of data: market open, close, and the high and the low of the candle. And the candlestick represents the opening price, the high, the low, and the closing price, like I just mentioned. The opening price of the rising candlestick is lower than the closing price, and vice versa. In the bearish candlestick, the opening price is higher than the closing price. Now, bearish and bullish are also key terminologies that we use relevantly, and bearish means that you are looking into the price of the product to go down, while bullish, the price of the product to go higher. Now, again, why is it important for us to know the trend? Charts basically helps us with trend identification. They help us identify trends in the market and anticipate potential trend reversals, like this part, for example. We are seeing a reverse of trend over here. We were going up, and then we hit a low. So it's important for us to know whether the trend is going to be reversing or it's going to continue. Obviously, this is an uptrend. We may have a little bit of corrections, but in general, this is an uptrend. So it's also important to allocate the support and resistance levels. Chart patterns, they help us identify the key levels of support and resistance, which will guide us to set entry and exit points, and as well amplify trading opportunities as we see the opportunities based on historical price movements. We also have risk management as a perk of reading charts. By identifying them, traders can identify potential levels of risk and set stop loss orders to protect against losses, and this is something that I mentioned in my previous webinar. So it's also a confirmation of other indicators that we can use in conjunction with other technical indicators to confirm or validate trading signals. In a later stage, we will tackle technical analysis in depth by understanding the concepts of these indicators in the advanced stage. So on the chart here, we have a downward trend and we have an upward trend. It's never just precisely that. On different time frames, it's definitely different, and we definitely see corrections here and there, but this is perhaps a long-term trend. So again, like I mentioned, when you open the chart, you are going to see the close, the open, the high, and the low. And some traders may prefer to use line charts, but the most common use is the bar chart, definitely, because you can read them even better and you can identify, like I mentioned, the high, close, low, and open. Line charts only represent the closing price by connecting them to each other, and they're usually used in the absence of opening price data, highest and lowest prices as well. So support and resistance. It is support is the price level allocated below the current price of the market and is expected that it will gather purchasing power and that the price will rebound upwards after the previous downward movement. So let's say that the prices are going in the up direction. We will take this blue line here as a key support because it has been touched by a lot of candles earlier on. And the resistance is basically the opposite. It's on the higher end of the higher highs that we've seen here. And it is a price level located above the current price. So let's say the price is here, it's located above, and we're eager to find out if it will be able to break above this resistance level that has been previously been touched before. Like I mentioned, it's a historical price pattern. So it's easier for us to allocate the support and resistance prices, which will also help us identify whether we have enough momentum to break this price level or not. Now, let's visualize that we have, for example, a gold chart and that this is the 2000 level mark. Obviously, we've touched level 2000 before, but right now we're trading here. So we do have the capability of going above 2000 again because we historically previously done that. So again, resistance is the price level located above the current price of the market with expectations of selling pressure and that the price will bounce back and reverse down after the previous upward movement. So we either have an upward movement that we can break the resistance despite how strong it is, or it will just give us a bounce to the down side again. Now, how to identify support and resistance? Prices always move forming peaks and lows. So as you can see here, peaks and lows. So it's either higher highs or higher lows. And usually each previous low is a support level from when the price is expected to bounce up. So we've touched the support, we're bouncing back up, we're back to support, and we're going back up. And that's what we use when we say support level. It's basically a level that we've previously touched multiple times, and it's like it's holding together the pattern of the chart. We can narrow it down to support and resistance. So each previous high is a resistance level from which the price is expected to bounce down, but it can also have a breakthrough, and later we're going to be discussing the breakthrough. Before that, I would like to mention that previous support levels can become resistance levels, and resistance levels can also become support levels. So here we have support level, and as we went higher and broke the resistance level, and now we're here, this resistance level has turned into support, and we have a new resistance point. So a breakout refers to when the price of an asset move above a resistance area or move below a support area, as seen here. This is a breakout, and or moves below a support area. They occur on high volume and show greater conviction, which means the price is more likely to trend in that direction. There is an exchange of rules between the support and resistance levels. If resistance is broken to the upside, then the latter becomes support level. And if the support level is broken, it becomes a resistance level. When the price returns to test any broken level, and the process is called retest. You may hear of this key terminology as well as we may speak to you guys. Sometimes the price breaks the support and resistance level and then forms a high or low and returns to close near that level again and does not complete its previous trend. This is known as a false break. So for example, over here, we've seen that it went low and then it went high again. We went into a little bit of a sideways movement, and even though it was going down to touch the previous support level, we can still see that it went higher. It did not break the support on the downside. No, it gathered enough movement to go into the upside, giving us an upside break. Anyways, we're going to be tackling further technical analysis in depth, using indicators and further advanced concepts for you guys. So stay tuned in our next webinar.